Hello and welcome back to All Things Money. I'm your host, David Blain. Thank you for joining us today on Cable TV 10 in New Bern and 94.1 FM WNBU, as well as all the people that are streaming this over the internet. As I mentioned last segment, we now have almost 2 years worth of video uploaded to YouTube. So people Googling either my name or All Things Money will come across these videos. So we welcome all the internet viewers out there as well. During the last segment, we were talking about how it may not be profitable for you to invest like Warren Buffett. And let me put a caveat on that is Warren Buffett's principles of not paying too much, looking for good values in companies that you understand, those principles, that's not what I'm talking about. I'm talking about looking at what Warren is buying and going out and doing the same. And specifically, I'm referring to his latest investment in Bank of America stock. I leave the financial stability of Bank of America as a bank up to the Office of the Comptroller of the Currency. So I don't want to create a run on the bank here. All the viewers out there, don't run out and take all your money out of Bank of America. We're talking about the stock. I don't know about the confidential inner workings of the bank and how solid it is. But as far as the stock, Warren Buffett put $5 billion into the stock. And what I'm suggesting to you is don't run out and blindly follow Warren Buffett. Why do I say that? Warren Buffett, of course, is a billionaire, and he's not going out and buying 100 shares of Bank of America, on the New York Stock Exchange. He's putting $5 billion into what's called a special preferred share of stock. And in fact, he's getting a 6% dividend yield on that stock, while the regular stock you buy pays less than 1%. Once again, I'm not suggesting whether it's a good or bad deal. I'm not that high on banks as a whole. I think since the banks have been around, they've generated tremendous returns for shareholders. You go in any city and you see the biggest building is always a bank. I personally keep as little money as humanly possible in a bank. But I do think that this financial crisis, I think some of the populist outrage at the banks, I do think that is somewhat altered the banking industry. Of course, you've got the credit, the act that was just passed, trying to reform some of the fees and things like that. And so I don't think that you can just extrapolate, banks have been, great money makers for the past, 50 years, going forward, they're going to regain their previous splendor. I think there have been some things that have changed. There's always going to be need for banks out there, but I think that some of the increased regulation, some of the increased scrutiny from regulators, as well as simply people, some of the abuses in the fees and things like that, people just aren't taking it anymore. So I'm not that big on banks anyway. But once again, Warren Buffett puts in $5 billion. He gets a 6% dividend. Now, the reason I bring this up is if we rewind the clock a little bit to 2008, Warren Buffett made a few investments back in 2008 at the height of the financial crisis. If you recall that he made an investment, once again, of I think it was $5 billion there also into Goldman Sachs, the gold standard investment bank on Wall Street. Well, let's talk a little bit about the deal that he got. So Warren Buffett put in $5 billion. At the time, Goldman had been worth over $200 a share, and it was trading at around $120 a share. And you would have got a dividend of about $1.40. Okay, so Warren Buffett puts in $5 billion. He negotiated a better deal. He bought preferred stock that got a 10% dividend. So once again, go back to 2008, you go out and you buy your 100 shares, $12,000, $120 a share, 100 shares, $12,000, you get about $1.40 per share dividend, just over 1%. Warren puts $5 billion in, he gets a 10% dividend on Goldman Sachs in 2008. Now, who wouldn't sign up for a 10% dividend in the middle of 2008. Tremendous investment. So every year, based on that, he gets a dividend check of $500 million. Once again, it's preferred stock. So he gets paid his $500 million. Then if there's money left over, Goldman pays out their regular dividend of $1.40, 1% to you. The other thing is that he also had the ability to convert some of this preferred to equity. And so he's getting this $500 million in dividend. Right now, Goldman's selling, and I don't know today, but roughly $110 a share. So you went out and you paid $120. It's actually worth less today, and so you would have lost about $1,000 on those 100 shares. Buffett has lost some as well, but he's collecting $500 million in dividends. So not quite the same deal. If you've got $5 billion to invest, you're going to get a little bit different deal. The same thing, John Paulson, we talked about the mortgage meltdown, how he's able to bet against the housing market, and he made $10-15 billion in 1 year. Well, you can only do that if you have hundreds of millions of dollars, billions of dollars to invest in the first place. You can't take your $1,000 and bet against housing back in 2006, 7, 8, like he did. Well, we're coming up on another break. When we come back, we'll talk a little bit more about some of Warren's investing and how you may not want to follow exactly what he does. So for All Things Money, I'm David Blain. We'll be back after a few short messages from our sponsors.